In this section, we will explore how Japan's trading companies have benefited from the weak yen, inbound tourism, and renewable energy projects in Japan. Trading companies are large conglomerates that engage in a variety of businesses, such as importing and exporting goods, investing in natural resources, infrastructure and technology, and providing financial and logistic services. Some of the most well-known trading companies in Japan are Mitsubishi Corporation, Mitsui & Co., Sumitomo Corporation, Itochu Corporation, and Marubeni Corporation. These trading companies have been able to take advantage of the weak yen, which has made their exports more competitive and increased their profits when they convert their foreign earnings back into yen. The yen has fallen to its lowest level in 2 decades against the US dollar, partly due to the Bank of Japan's ultra-loose monetary policy, and partly due to the global oil and gas price surge that has widened Japan's trade deficit. The weak yen has also boosted inbound tourism to Japan, as foreign visitors find it cheaper to travel and shop in Japan. Japan lifted almost all remaining coronavirus travel restrictions on October 11, 2021, and expects a surge in spending by international tourists, especially from China, which accounted for about a third of Japan's foreign visitors in 2019. Economists have estimated annual foreign tourist spending could exceed the government's annual target of 5 trillion yen, $35 billion, a level that would help offset the higher costs of imported food and energy. Trading companies have been actively involved in promoting inbound tourism to Japan by developing hotels, resorts, shopping malls, and other facilities that cater to foreign visitors. For example, Mitsubishi Corporation has invested in a luxury hotel chain called Prince Hotels and Resorts, which operates 43 hotels across Japan and overseas. Mitsui & Co. has partnered with Marriott International to open more than 30 hotels in Japan under various brands, such as the Ritz-Carlton, JW Marriott, and Courtyard by Marriott. Itochu Corporation has invested in Hoshino Resorts, which runs traditional Japanese-style inns called ryokans. Another area where trading companies have benefited is renewable energy projects in Japan. After the Fukushima nuclear disaster in 2011, Japan has been shifting its energy mix away from nuclear power and fossil fuels towards renewable sources, such as solar, wind, biomass, and geothermal. The government has set a target of increasing the share of renewable energy to 36 to 38% by 2030 and to 50 to 60% by 2050. Trading companies have been investing in renewable energy projects both domestically and internationally, as they see them as a source of stable income and a way to contribute to environmental sustainability. For example, Sumitomo Corporation has invested in offshore wind farms in Japan and Taiwan, solar power plants in Japan and India, and biomass power plants in Japan and Thailand. Marubeni Corporation has invested in geothermal power plants in Indonesia and the Philippines, hydroelectric power plants in Laos and Myanmar, and solar power plants in Chile and Mexico. As you can see, Japan's trading companies have been able to leverage their global network, diversified portfolio, and financial strength to benefit from the weak yen, inbound tourism, and renewable energy projects in Japan. These factors have helped them overcome the challenges posed by the COVID-19 pandemic, the energy crisis, and the geopolitical tensions. In the next section, we will discuss how Warren Buffett and Wall Street banks are saving Japan's economy from recession. One of the ways that Warren Buffett and his company Berkshire Hathaway are saving Japan's economy from recession is by taking advantage of the huge gap between American and Japanese interest rates. Interest rates are the cost of borrowing money. When interest rates are low, it means that money is cheap and easy to get. When interest rates are high, it means that money is expensive and hard to get. Japan has some of the lowest interest rates in the world. The Bank of Japan, which is the central bank of Japan, has kept its policy rate at minus 0.1% since 2016. This means that banks have to pay the central bank to keep their excess reserves there. The Bank of Japan also buys government bonds and other assets to keep long-term interest rates low and stimulate the economy. The United States, on the other hand, has higher interest rates than Japan. The Federal Reserve, which is the central bank of the United States, has kept its policy rate at 0.25% since 2020. This means that banks can earn some interest by keeping their excess reserves at the central bank. The Federal Reserve also buys government bonds and other assets, but less than the Bank of Japan, to support the economy. The difference between the interest rates in Japan and the United States creates an opportunity for investors like Warren Buffett to borrow money in yen and invest it in dollars. This is called a carry trade. A carry trade is a strategy where an investor borrows money in a low-interest rate currency and invests it in a high-interest rate currency, hoping to earn more than the cost of borrowing. Warren Buffett has been doing this by issuing yen-denominated bonds through his company Berkshire Hathaway. A bond is a type of debt that pays a fixed amount of interest over a period of time and returns the principal at maturity. A yen-denominated bond is a bond that is issued in Japanese yen and pays interest in Japanese yen. According to Bloomberg, Berkshire Hathaway sold 128.5 billion yen, $1.13 billion, in bonds in January 2022, marking its fourth bond deal in the Japanese currency in as many years. The company priced a multi-part debt offering with maturities ranging from 5 to 20 years and coupons ranging from 0.203% to 0.8%. A coupon is the annual interest rate paid by the issuer of the bond. By issuing yen-denominated bonds, Warren Buffett can borrow money in yen at very low interest rates and use it to invest in other assets that pay higher returns, such as stocks, bonds, or businesses in the United States or elsewhere. For example, Berkshire Hathaway owns stakes in 5 major Japanese trading companies: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. These companies are involved in various industries such as energy, commodities, machinery, finance, and consumer goods. However, there is a risk involved in this strategy: currency risk. Currency risk is the risk that the exchange rate between two currencies will change unfavorably for the investor. For example, if Warren Buffett borrows money in yen and invests it in dollars, he will have to pay back his debt in yen at some point in the future. If the yen appreciates against the dollar during that time, he will have to pay more dollars to buy back yen and repay his debt. This will reduce his profit or even cause a loss. To hedge his currency risk, Warren Buffett uses derivatives such as futures or options contracts. A derivative is a financial instrument whose value depends on the value of another asset or variable. A futures contract is an agreement to buy or sell an asset at a specified price and date in the future. An option contract is an agreement that gives the buyer or seller the right, but not the obligation to buy or sell an asset at a specified price and date in the future. By using derivatives, Warren Buffett can lock in a favorable exchange rate between yen and dollars for his future payments or receipts. This way, he can eliminate or reduce his exposure to currency fluctuations and focus on his investment returns. In summary, Warren Buffett is taking advantage of the huge gap between American and Japanese interest rates by issuing yen-denominated bonds and hedging his currency risk with derivatives. This allows him to borrow money cheaply in Japan and invest it profitably elsewhere, while also supporting Japan's economy by providing liquidity and demand for its currency.